for more in a CNBC exclusive. Max Levchin, co-founder of PayPal and the CEO and founder of Affirm. Great to see you, Max. Thanks so much for joining us.
Thanks for having me.
Quickly, explain to us what Affirm is for those that don't know.
Affirm is a pay over time solution. You typically find us at a checkout on both online and offline retail, as far as every Walmart in the nation, and as wide as Peloton and Casper and lots of brands. And what we do is allow people to use an alternative, Affirm, instead of their credit cards. The difference is that you don't pay revolving interest. The cost of the funds is very clearly disclosed. We don't charge any fees, including no late fees. So it's a very safe, very comfortable solution for mostly young people to use.
So you essentially give the buyer a better price in terms of what credit or interest rate they pay, but do you take on more credit risk because of that?
No, because we underwrite every transaction separately and we make sure that we will not extend credit unless the person is capable of paying us back. Not only is it better priced, it's also much more transparent and easier to control because we don't allow revolving. You know exactly how many times you'll take to pay it back, and once you're done, that's it. There's no way to stay in debt forever.
So obviously this, and as a co-founder of PayPal, you know an awful lot about online payments in the financial world. And there have been a lot of movement here by a lot of players, names like even Google looking into checking accounts. What do you make of that from both a business standpoint and from the consumer standpoint? Is it safe? Is that something that should be encouraged right now?
I think on the whole, it is a good thing and a good development. If you look at the financial services industry, so the traditional one, you'll find that much has been said about their lack of new ideas and development. And so the fact that technology companies like my own, they're coming in and say, hey, you know what, there's a better, cheaper, more efficient, more transparent way of doing this for the customer is generally a good thing. From the consumer's point of view, Affirm was founded almost 10 years ago now, after I read a study that said that most millennials, back then they were still before credit card age, most of them, and the study very clearly said that they expect their banks to be named Google, Apple, etc. And I thought, why not a new one? But more importantly, clearly the young generation is looking to technology companies to provide financial services.
At the moment, tech's foray into the world of banking has been into individual niche areas. That's an oversimplification, but generally the case highlighted by the fact that Apple has partnered with Goldman Sachs. Google is partnering with Citi. They're not seeking to be banks themselves. In 10 years' time, does that change? Will JP Morgan Chase's biggest rival be a Google, or will it still be a Wells Fargo?
That's a $1 trillion question, roughly judging by the market size. I think a lot of it has to do with the regulator's point of view on whether this is a good thing or not. If you look back in the last decade, there have been very few new bank charters issued because the regulators have understandably been cautious after 2008 in terms of offering new charters. But I don't think what you said is precluded. In fact, I think that's a likely conclusion to what will eventually be a consolidation.
Have you had enough experience in business with your customer base to know how their purchase activity, their credit behavior compares to those who are principally using credit cards or other means?
Yes, one of the things about Affirm that's really great is that these are very short-term, fixed-term obligations. So you typically pay us back in 3, 6, 12 months. So we have many what's called close cohorts where we've seen that people pay us back better than they do with credit cards. You can generally say that they behave more responsibly. You can generally say that they seek control with us and they find it, and so they feel much more compelled. They're also pleasantly surprised that we don't charge late fees, and so when that happens, they tell their friends, and also their behavior seems to improve with the next loan.
What does that suggest to you about consumer behavior right now if more and more customers are using this form of paying over time?
I think there's a massive trend that is now impossible to ignore. There's an enormous drive, especially by the young demo, but also even the ones my age, so saying, credit cards are fundamentally designed for me to revolve, to pay the minimum payments, to stay in debt until I die, while these new systems are designed to make sure that I get what I want and be done with it and pay it back on time. If you look at sort of the Christmas shopping that's coming up, one of the things that we've done is we've surveyed a ton of our customers and customers outside of Affirm, and the number one stressor that people quote is, I don't know how I'm going to afford this. Last year I went into debt. I'm still paying it off. The fact that you know exactly when you're done with the burden that you took on during the holiday shopping is what drives people towards solutions like Affirm.
I wanted to go back to that bigger picture question in terms of tech companies not becoming full banks yet. And clearly, I understand the argument why a Google or an Apple doesn't yet want to apply to be fully regulated like a bank. Should your old firm, PayPal, though, take that next step and seek a bank charter? It feels like it's in the perfect sweet spot to be a modern tech company, but to start to eat more of the lunch of its banking rivals, but at the moment perhaps doesn't go the whole way.
You know, one thing that I know about PayPal is that Dan has done a stellar job taking it from 1 to 2 to misquote Peter Thiel. I think when we were running it back in prehistoric times, we were very focused on building a point solution, and I think Dan is fully in charge of that ship, and my guess is when the time is right, he'll go for that.
Fair enough, not commenting on the old company. What about, quickly, just the price war we've seen in the brokerages? Do you think that was sparked by Robinhood and the likes of Robinhood coming into that space? And do you think that ultimately the losers of the Charles Schwab TD Ameritrade deal are in fact the likes of Robinhood who sparked the deal in the first place?
Again, hard to comment on behaviors of gigantic corporations, but my guess is consolidation in the face of intense competition from the ultimate price cutters, people that replace complex systems with new ones with algorithms, is part of the motivation. And my guess is the markets are so large, it's very hard to identify losers. Efficiencies will come, although I say that with a little bit of a smirk. Taking companies that advertise the integration cycle of 36 months is probably, there's some low expectations being set there. So my guess is the startups are still safe in all these industries.
Just quick final question. Of course, know Elon Musk very well. What did you make of the launch last week? I mean, that was pretty comic, was it not?
It's vintage Elon. He, in the long term, will deliver something amazing. He does not shy away from doing strange things on stage, and yet somehow it seems to work out for him. It seems like they've been able to sell almost 250,000 trucks even after the comedy hour.
Pre-sales of $1,000 isn't selling a full truck, but do you think $100?
Yeah.
Gosh, even cheaper.
Yeah.
But was that a big blow to him, that launch? Do you think?
I've said it before, and I'll say it again. Elon's most sort of amazing gift is that he has complete inability to imagine himself failing. So as a result, this will be a thing that is in the rear mirror of his truck well before the end is done, and so the day was done. And so I think he'll move on just fine. I don't think it was a blow for more than the nanosecond that it took him to put up a.
Or the 2 nanoseconds, the second window too.
Right.
Yeah. No, Max, thanks so much for joining us.